All right, excellent. Well, good evening and good morning for some of you. Thank you for joining. And yes, I will get to speaking about the Nadex product, and it's short for North American Derivatives Exchange, and it's one of the new exchanges that are up in Chicago, and they are legitimate, and they are new, and they're picking up lots of traction. And they're phenomenal for the reason that they will give you an opportunity to trade the markets, gold, crude, indices, forex, even some special events markets, such as an earnings report. No, not an earnings report, but Fed news. But they will. Well, 3 years for me is new. I've been around since for a while, so 3 years for me is a brand new exchange, and they are picking up a lot of traction. And I remember I was one of the early adopters of they were called closed-end trusts back in '95 and '96, and it was called a Nike Dow Trust, and then it turned into the ETFs, and then it turned into spiders, and then the iShares, and I was one of the early adopters. And some of the same concerns that we had with those early adopters were the volume wasn't there, the liquidity wasn't there, the spread was too large, and I knew that the ETFs and the iShares would be very huge. Now, of course, I didn't anticipate that it would take over the mutual fund industry. I thought they had a lock on that industry. But who here trades a mutual fund these days? Probably no one. And that was unheard of just 10 years ago, maybe 10. So Nadex is, I foresee the very same future, and the reason being is there are less market makers in the market with the Nadex product, and therefore this gives you an opportunity to trade as a market maker. And what I mean by that is there's a bid and there's an offer, and you can either accept to sell at the bid, or buy at the bid, or sell at the offer, or vice versa, or you can be a market maker and take a spread or a difference. And there are opportunities to do so, but I wanted to discuss not just a product, not just an instrument, but the actual markets themselves and who controls the markets. And as long as you can get on the right side of the trade, I don't care what you use. You could still use a mutual fund if you want. You can use index funds and ETFs and iShares and Nadex products and stocks and options and everything that we've talked about here today. But there was some amazing presentations here, and I think this is an amazing opportunity for everyone here and everyone listening for the recorded seminars or the recordings. This 24-hour education opportunity is huge, very, very huge. So my name is Kai Whitney, and I'm part of a trading group, a global trading group by the name of globaltraderoom.com. And you'll see here that's institutional analysis and professional knowledge, and it's a futures FX creation and educating since 2004. So it's been around for a while, and this is a new name, new branding, but we offer free trials every single Tuesday. And this is an opportunity to look over the shoulders of a professional trader. And you can see the actual trades that are occurring. They're being called out, the exact entries, the exact exits. You can see them on the chart. And he's also a license to do so. So he's a commodities trading advisor. So if you wanted to, normally if you want to have a commodities trader or hedge fund trader or private trader trade your money, you have to be a CTA and licensed. So there's opportunities to join us, and we will open this up for everybody that's here to our capacity that we can do. Excellent, excellent. To our capacity for tomorrow morning, we start up at 8 a.m. and go to 12:30 p.m. And then we also trade, so we'll trade the morning and the afternoon sessions. The morning sessions are strictly for trading. So we are going to trade everything under the sun, anything that moves. I mean, gold, crude, forex, euro. I was about to say S&P, but that doesn't really move. But we're gonna trade everything and a lot of different things with a strategy. the strategy is we're actually going to read volume profile and market profile. We're going to trade alongside the institutional traders. And I want to talk about that today because I recently put together something that it was pretty well received, and because of course the subject applies to options and futures and forex and stocks and anything else you want to trade. And again, as I mentioned towards the end, I'm going to show you how to trade using the same information but using the new exchange, and it's called binary options. And that will be an opportunity to trade with, you know, as little as $100 with 90 cents, 90-cent exchange fees, no commissions. So the topic I want to talk about is how to decode order flow volume. We are big proponents of reading the market's raw data. And back in the day, it was time and sales, it was reading the tape, and it's the footprint, the bid and ask footprint, et cetera, et cetera. But I want to talk to you about how to decode order flow and finding the institutional support and resistance levels using order flow. So I'm going to teach you three things. I'm going to limit it to three, but it's about order flow, decoding the order flow volume. And this will, no matter what level of trading you're at right now, this will radically change the way you look at the markets. I promise you. So, but normally, most people think of order flow as reading, time and sales, and it's running across the tape, running across your screens, or they're reading a bid-ask tape, because that's mainly how it was used before high-frequency trading and algorithms made the order book pretty much obsolete. There used to be something that we traded by, which was called the New York Stock Exchange order book. But many of the original traders or order flow traders that I used to trade with are no longer around because you need to have a supercomputer for a brain to read the order book just through watching the time and sales anymore. So, of course, when most us retail traders encounter what's called tape reading or order flow reading for the first time, it feels like it's an avalanche of numbers that need to be analyzed, and which of course would be, and no doubt it's a daunting task. But even worse, most retail traders get intimidated by numbers. They think they see numbers, and all of a sudden they have to do complex math. And if that sounds anything like you, I'm here to say that you've been pretty much making things too hard. It's not about the time and sales. It's not about order flow all the time. It's about knowing what data is most important and how to interpret it so you know where to take the trades. So that being said, I can't obviously teach you everything there is to know about order flow in the next 45 minutes to an hour, but if you want to go deeper with what you learn here today and start applying it to your trading, I'll be making, you can always obviously click on this link here. It'll be for tomorrow morning, 8 a.m. It's going to go to a registration page. That will be us in the morning looking at volume profiles, and I'll talk more to that for those that haven't been familiar with it. Okay, but let me start this little presentation I have. Okay. So one of the problems that we have, as I mentioned in the beginning, is the depth of market and reading the book and supercomputer, for a brain, and high frequency trading and algorithms and complex numbers and math and everything like that. But the first thing you really need to understand about decoding order flow is hidden trade locations. And what that's going to mean is it's a solution. It's a solution to decoding all of the information, the bid and the ask, the time and sales, the volume at price, the block trades, anything you can think of. There are messages within that information. One of my favorite movies is The Matrix, and it's one of those scenes where you see the background, which is all characters. And in the beginning, Neo, that's all he sees as well. But then again, yes, very much so. You stop seeing the characters and you see the blonde with the red dress. And that is what the markets are all about, especially today. It used to be, more, handshakes and under the table deals and private negotiated trades and all this kind of good stuff. But now it's actually the algorithms and high frequency trades and the no spreads, the penny spreads and half a penny spreads and whatever. They've actually opened up the opportunity for us. Is someone having mic problems? Are we good? Audio's good? Yes? Okay. Okay, good deal. But with all of this information, whether it's an analyst call or it's an implied volatility or it's high volume here and low volume there are actually messages that are hidden within the bid and ask. And I want to show you how to identify this information, even if this is your very first webinar that you've ever seen. It's easy enough to do it from day one, okay? We now have the tools. We are now on a level playing field where the algos, we don't have to be afraid of the algos and the icebergs and things of that nature. It's actually giving us opportunities, specifically with the development of the footprint, the bid and ask, and things of that nature. Okay. I'm projecting. But before I really get into things, let's talk a little bit about my background and why you should listen to me. So, does everyone see? This is myself here. Why you should listen to me? Everyone clear? Okay, excellent. So again, hidden trade locations. I want to give you a little brief outline about my unique institutional experience that has led me to this level of understanding that few in these type of venues have. It will also give you a little color about the 3 points that I'm going to teach you. I have been involved in the market since 1994, both from the buy side, venture capital and private equity as an analyst. And what I did is I identified the mergers and acquisition deals for the firm. But I also spent time on the sell side for firms such as Swiss Bank and Bear Stearns, where I traded for some of the largest hedge funds and corporate accounts in the world. This is our main floor. This is out in Connecticut. It's UBS Swiss Bank. This is 2 football fields under one roof and 1,500 traders. And I'm just here to tell you that this is your competition. There is information. There is information that they have that we have as well now. It's information that you can discern from looking at the time and sales, the order flow. Is there anyone else that's seeing no projection? I'm sorry, I'm not. Interesting. Some are not. Okay. Wow. Almost half of you are not. I apologize. I don't know what to do. Maybe hit F5 or boot and reboot. Anyhow, again, I actually traded for the Pathway Capital, which was a $35 billion private equity fund. And it would literally take me weeks to purchase and sell a position because the size was so large. We knew we could damage the market or the stock. And we could definitely take out 10% of the float, which is kind of one of the watermarks. So I have an understanding of what I'm talking about, which is institutional trading. But most importantly, I also saw the writing on the wall at Bear Stearns. And I left December 28th in 2006, just enough to be able to sell my my retirement out at about $100 a share. And everyone probably remembers that J.P. Morgan famously bought Bear Stearns for $2. From there, I went to one of the largest high-frequency trading firms, which is under the name of SunGard, and I traded on their proprietary trading desk, Ascent Capital, where I was pretty instrumental. I had a good background in finance, and I was pretty instrumental in really shorting the entire financial-related sector until, including Bear Stearns and every mortgage-related banking company I could find until it became illegal to short them. So this experience has led me to develop the first point that I'd really want you to write down, and it's called hidden trade locations. Does that help? So one of the problems that I see the majority of traders that I work with is they don't understand trade locations. Trade locations is like real estate in the market. It's all about location, location, location. In short, hidden trade locations is about being able to identify where to take a trade based on the probability that an institution will either defend that area or not. And what I can tell you is that the hidden trade locations will show up as volume imbalance. The risk is if you're not able to identify these trade locations, you're not trading with those that move the market, but you're trading against them, whether you know it or not. The second point is that size matters. And simply put, the market is controlled by institutional order flow and high-frequency trades. In fact, greater than 62% of the daily volume is program-related. And who do you think writes these programs, and who do you think backs these programs and runs these programs? It's the institutions. So in other words, you can kick and scream, all we want about how unfair it is, but you're trading against the institutions, the market movers, whether you know it or not. And it is the institutions and commercial traders who move the markets and not us. It's not, our 1s and 2s and 3s and 5s lots that we trade. So trade location is critical because it's the size of the institutional trade that creates, I used to be really big into surfing, and I look at the institutional trades as a set wave, and the sets will come in, and you can either pick up one of those set waves and ride them, 50 yards, 100 yards, or you call it wrong and you dig your nose in and you're on the rocks. And it's, it's basically you're trading against a giant that if you can understand and respect it, you can actually have fun with it, and you can actually understand what's going on. So the second really important thing about the solution to decoding order flow is about an institutional bias. And what I mean by that is losses come first, and losses are more important than profits. And shocking, retail traders take on way too much risk for their account size. So the second thing that you need to know about decoding order flow is what I like to call institutional bias. And when you're working on a desk at a hedge fund or an investment bank, that bias is all about risk. No matter really what you're hearing about in the the London whale trades and things of that nature, it really is all about risk and losses. Losses basically, they come first. Because if you continue to lose on your trades, or you keep reporting bad prints back to your clients who you're buying and selling for, the large institutions, your last meeting is with your trade manager. Of course, there's going to be a little cardboard box sitting right there in the chair next to him with 2 security guards as you walk into the room, and they're there to escort you out down the elevator. So of course they'll let you, take your pictures of your wife and kids, but that's about it. But the second, you need to also understand about institutional bias is losses are more important than profits. Now, what I mean by that is it's not how much you can make on a trade. We can never truly identify or know. There was a discussion earlier about getting involved into these small cap stocks. Who's there to really know that next small cap stock is not going to turn into the next gigantic, $1 trillion market cap company? You just don't know. But what you do know and what you can control is it's the probabilities and how much risk you can take. And that's the way the firm or the professionals will take it. So they will approach an investment. They will approach a trade based on how much risk the overall firm will have on its books. And what that means for you and I is that with a strategy that you have tested and you've found high probabilities with, no matter what, that there will be losses, but more importantly, to take those losses quickly and then take the very next trade because the odds of success will be that much greater. And my last point about institutional bias or institutional mindset, if you will, is that us retail traders, when we're all first getting started, we think that by giving a trade room to work out, it's going to magically turn around and go in our favor. And I'm here to tell you that it's absolutely wrong. It will. The market is dynamic, and for every tick that goes against you in your trade, it sets up for a counter move that an institution could come in and obviously slam it and send it in the opposite direction. So when trading on a desk, we would open up with the market. We would take a number of trades, and what we would do is we would blow out of the ones that were losses quickly and then ride the ones that were working and manage the risk from that point on. And that is part of the process. So that's a very good question. So TL is asking, may I ask a curious but serious question? With all the knowledge and professional traders that Bear Stearns had, why did they fail? Let me tell you that most of the traders at these firms, they drink the corporate Kool-Aid. They drink the corporate Kool-Aid. I was not, when I say I saw the writing on the wall, I was not quiet about what I saw. You're absolutely right. Absolutely right. There are great books. There's history being made, and there are great books on everything that happened. And you're talking about taking down. Put it this way: if you can take down a giant with 150-year history, this market can take down anybody. And if you can, that's why it's very important to understand it's not about the trade that's setting up. It's about the risk that you're willing to take. How much risk did Bear Stearns and Lehman Brothers put on the books in the debt markets? They completely were chasing profits and greed. Don't get me started. Yes, exactly. Steve's going, hello, it happened back at Barings Bank a long time ago. But the fact is that the story never changes. It's always the same thing. It's like a house of cards, and they simply shuffle. They shuffle the shells. It's unbelievable. I mean, think about how many stocks will do reverse splits and change their names of the companies and change the names of the board and the CEOs. Anyway, I go into this daily in our live trading room. But what's important is, of course, we talked about the hidden trade locations, institutional bias, and how if you're trying to trade the markets without reading the markets, reading the market is actually transparent according to the Chicago Board of Options Exchange. It's set up to be transparent. All markets, the Nadex market, is set up there to simply bring the buyers and the sellers together. It's simply there to facilitate trade. There's no bias on the markets. All it wants to do is bring buyers and sellers together. So one of the sayings that I learned from my mentor, Simon Joseph, is volume leads to price. So there's ways that you can use the volume profile. And what we do daily in our daily room is what we read the volume profile, we read the actual numbers that are coming through, we read the raw data, and it really allows us to, the point number 2 is have that institutional bias, where it's all about risk, and it's risk management. Some may come into our room and say, oh my gosh, you guys are doing, 1,000 cuts to get a big trade. But again, it's the probabilities. It's the probabilities, it's the institutional bias, it's being in the position to pick up, to have that opportunity to get that 100 tick, 200 tick, 400 tick trade. Of course, there's different ways you want to manage it based on your account size, but and Nadex is a great opportunity to do that as well. But before I tell you about the third, and really it's the most critical part, and I'm going to tie this all together, and I will show you examples. It's what I dubbed, or I named, it's called the order flow sequence factor, or order flow sequencing. And what I mean by that is, well, let me go into real quick. I see some are still having issues with the screen. I apologize. Let me just get rid of that. Does that help? Okay, Global Trade Room. Let's go there. Sign up for, you can go and click on, this is free. We have a free trial. Overlook. Okay, here's an opportunity. Here's an opportunity that I had that many don't have. I was either lucky enough or smart enough, or I knew the right people to get in, and trade at some of the best firms in the world at the time. And best part of all is sell when I needed to sell. Isn't that probably the greatest trade ever? But one thing that we did is whenever anybody comes in, any of the interns from Harvard and and Yale, all these fine schools, when they come onto the desk, what they have the opportunity to do is look over the shoulder of a professional trader. Yes, they're getting coffee and they're getting laundry and things like that in the beginning. I understand. It's it's kind of like if you're in a if you're in a fraternity, it's kind of the same thing. But at least you have the opportunity to see the methods at work, and you see the madness, and you see that it is possible. And you'll also see a common ground. If you read things like the Market Wizards, you're going to see a commonality between all of those great traders. And the commonality is you cannot tell if you're sitting next to a great trader. And I'll tell you now, I sat next to when I was at the prop firm, when we were trading basically our own money, there was a guy right next to me who would literally make $50, $75, $100,000 a day for his own account. He was swinging about $5 million, and I was swinging about $1 million at the time. And I would do 3,000, 5,000, maybe 15,000. So I was I felt I was a piker, and a small fry. And of course I wanted to be like this guy. And no matter what, even if I sat right next to him and I talked with him, there's really nothing. There's nothing more to that than what this opportunity is by joining us for this live session. in the end, what you're going to find is there's a lot of trades being happen. There's a lot of trades happening. There's lots of money being made. There are tight stops being made. We're not going to obviously go into detail about the strategy. A lot of it's going to be off screen because we're obviously going to be showing you a live account and things of that nature. But understand that what you're looking at is an actual professional who does this for a living day in and day out. And it's an opportunity that is few and far between because he's really licensed and the CTA to do so. He can call out the trades and things of that nature. So anyway, the thing is with any indicator or strategy, any of the discussions we've had earlier, you need hands-on and real application of these tools. And it can't be just about theory or theory-based training. We not only provide live trading in the mornings, but hands-on education, special order flow tools, day in and day out. And you can start applying what you are learning here today. So if this is reminiscing with any of you, if it sounds like a good fit, just go ahead and click on the free link. There's no commitments. Register, live session. You can also register for tomorrow's Tokyo session. And of course, if you have any questions, you can stick around after, after I talk about point number 3, which, remember I said it's really the third important aspect is called decoding order flow, and it really is. But it's called sequence factor, and the key is not just knowing the particular sequence occurring, but where the location it occurs at. So this took me a number of years, a lot of years, trading very large positions, for hedge funds and private equity firms and pension and corporates and all this, all the good stuff, to figure this out. But quite frankly, without that experience, you really probably would have never thought of it or figured it out, yourselves. But again, it's not about time and sales or order flow all the time. So when you look at, let's see if I can go back to, here's an idea, or here's an example of order flow. One of the best tools out here is jigsaw trading, and it's an add-on for NinjaTrader. This is an amazing tool. Now, some of you may be looking at this. So this is a depth of market tool, okay? This is your time and sales in the center. And some of you may be saying, that's just too much information, TMI. How am I supposed to possibly figure this information out? Well, it's about, what I look at here is I see patterns. I don't see just the characters. I see the blonde and the red dress. I see, block trades that are occurring at particular levels, on both sides of the trade. Yes, there you go. And it's not just about the time and sales, but it's how aggressive are they being at that location. And that's what's important. Now, this really is when you're trading again at a firm, you're not looking at moving averages or candlestick patterns. Of course, you know all that. We go through training, at headquarters for weeks and weeks, and it's day in and day out. It's like going to boot camp if anybody's been there. It's just drilling and drilling and drilling and drilling, and you figure it out over time. If you don't, of course you're pretty much you're kicked out of the firm. But it's not about all of these numbers all the time. You got trading boot camp, exactly. But what it is, and I'll show you this. This is an example. I use. There's a number of tools I'm going to show you. I'm going to show you a few. I'm not pitching any of them. Some of them are quite expensive, but for me, oh no, very good question. And I'm not talking about trade location as far as I'm trading from San Francisco, my latency time to the Chicago firms. No, forget about all that. That's not important, honestly. It's really not. Only if you're high frequency trading and you are a program does that make any difference for you. But this is an example of one of the charts that I look at. Okay, do you see all these zeros here? All the zeros are ones and zeros and twos and threes, and the algorithm's piecing them together to try to make something. But what I filter them for is I filter them for block trades. This happens to be crude, and I filter these for block trades. And again, it's not about how, okay, a block of 19 happened here, a block of 15 happened here. But what I will be interested in is I'd be interested in this block of 20 and 16 at the same price. Or towards the end of the auctioning process, I see that they're stacking here at this 93.60. And this will be a level. This will be a level that I'll be interested in taking along from. Because I'll be interested in taking along from it because what could possibly be there is a fund is either trapped or they've completely finished selling, and I can take a trade from one tick above that. And what will happen is these guys, these block trades, will have to cover at worst prices. They'll have to, if they're short, they have to cover at the ask, and that is what really runs a market higher. And as the market's moving higher, it's not looking for more buyers as it's going up. What it's looking for is the opposite side. It's searching for value. And value in the markets can only be found by finding, if you're a buyer, you can only find value as a seller. But that's important when the location, and that location can be found very easily by either reading this raw data here or the volume profile. For those that haven't seen a volume profile, this is another tool here. An example would be, this is a crude trade, and what I have this filtered out for is I have it filtered out for block trades. Now, I'm not interested in just selling, okay? I'm not interested in, excellent trader, that's a great question, and that's the beauty of what I'm talking about. It's not about just the fact that I see selling occurring, but I see block trades occurring. And if I see in a situation where block trades are happening to the sell side or to the buy side and the price is actually not moving, I'm looking for a trap in a reverse. In this possible situation here, I see that the filter was identifying not only sellers, but block trades. And so I'm going to take a short from up in this area based on the fact that there is a value area high, the value area low, and I don't want to lose too many of you right now. But this is a way to trade among the institutional traders. I'm taking a trade here based off of this price movement outside of what's called value. And I'm taking this trade also because I can see that not only sellers are selling, but block sells are occurring. They're really aggressive hitting the tape. And that is what's important. That's what really will give you the opportunity to take a trade with a few ticks risk, believe it or not. So again, it's not about order flow. It's not about time of sales. It's not about indicators. It's all about the location of these trades. I'm going to show you. I'm going to show you an example. This is a video of Simon, my mentor, and this is a live session happening Friday morning. I believe it's Friday. Yeah, 22nd. And what you see here is on the far right-hand side of each one of these charts, you'll see different time frames. 144 tick chart on the far left. On the middle, you're going to see 466 tick charts. On the right, you're going to see 997 tick chart. On the bottom middle is 1597 tick chart. And on the far right is 1,000 volume chart. Okay? So there's multiple time frames, and we're looking at this colored volume skew. And what we're identifying are opportunities. See, in this crude trade here, it's a long. He's taking a long in this area where there's lack of volume. There's less volume. And then the opportunity is to the top side. And let me just show you, just so you have an idea what you're looking at tomorrow morning. Tick charts, minute charts, volume charts, range charts, you name it. Okay, so I don't think you guys can hear this. Let me go ahead and stop it then. No big deal. But that's what the charts will look like tomorrow morning. It's going to be a price chart. There's going to be a volume profile on the far right. You can bring in the bid and ask. We're obviously not going to discuss in detail our strategy, but you can obviously you will be able to see tomorrow morning 8 a.m. to 12:30 p.m. And then again during the Tokyo Open, we will open up our room, one of our rooms out of Hong Kong, from 7 p.m. to 9 p.m. So I won't go through that further. I just wanted to show you. Let me go through some I want to go through a couple things here before I lose your attention. Yes, everyone can attend. Just go to the link here. I'm sorry. Go to the link of go to globaltraderoom.com. I'll post it here in the chat box, but I'll also click on the link here for tomorrow morning, and you can just register there. And we're not going to be able to answer a lot of questions. Let me just forewarn you. It's all about trading. It's all about making 50 to 100 to 200 ticks in that session. All we want you to understand is that by using order flow, by using the sequencing patterns, by understanding the way the market operates, you can really mitigate your risk. You can absolutely take on this institutional bias that I talked about. And it's unbelievable, you can take trades in crude. As I mentioned, retail traders are taking too much risk. Most traders that come to us, they come to us with, thank you, they come to us with their taking 15, 30 ticks risk, 2 to 4, 6 points risk in the sorry about that, in the S&P. And you're taking on too much risk. You honestly are taking on too much risk. You do not need to do it. Specifically because when you're reading order flow, and you're reading it not just about all over the place, but you're focusing on these specific location areas that can be identified beforehand. It literally can be identified beforehand. And all you have to do is, as the market is coming into that level, you start to look at the bid and ask, and you say to yourself, you watch the tape, and you go, are they being aggressive here? Or are they being responsive? If they're being responsive, you want to go ahead and take a position, and your risk can be mitigated to 4 ticks, 6 ticks in something like crude, which is completely erratic, or something like gold, or the S&P, which is totally liquid. But the importance is, once you're in that position, you can also look at the order flow. And if they do not come in aggressively with volume and balance, where, in other words, a bid, let me see if I can pull up something live. That's not going to do it. Sorry. This is the S&P. Okay, this is, I guess, we're flat. But anyway. Okay, here is, let me show you as we were going into the close of today. Notice these cells. Okay, let me make sure that everyone's following me. I don't want to lose anybody here. This will be good stuff. Everyone here? Okay. 10T. You want me to respond to a question? 10. What software? Oh, sorry. I apologize, Fred. This is a Ninja Trader software. This is something particular that I developed with an indicator company called NinjaCators. And what I wanted to see is I wanted to look at the bids and the offers on the S&P, for example. But I'd also like to see, I want to know when there are block trades occurring, okay? And when that block trade occurs, I want to see a line thrown out. And what this is telling me is as I'm looking at this price here, as we're coming into the close, I see heavy selling. But I don't see the price going much further. So what I'm seeing is that sellers are exhausted. They're not able to move the price much further. What that really means behind all of this is it means that the buyers are actually absorbing all of these sells that are happening. You see this negative 1966, negative 445, negative 1364, negative 5,000, negative 35. If you can't hit the tape and you can't take the price down, that means the sellers are exhausted and the buyers are overpowering the market. And so therefore, you want to look for a long. That would be, this whole area right here, this 1800 area would be a trap for the sellers. So you want to get long. Obviously, this is not going to show us anything now. Oh, I guess it's coming up a little bit. We're at 1804 and back to 1803. We're floating. But this is an opportunity here where if you don't want to get involved now in the futures market, what you can do is you can go to, and you can risk less by going to this Nadex. And let me show you exactly what I'm going to do. I didn't want to put this trade on until I told you guys about it. I didn't want to front run it, okay? So I'm just going to open up. I'm going to show you a sim account, but this is what I'm going to do. So the Nadex is going to give me an opportunity. This is an exchange. I'm going to look at the bull spreads on the indices. I'm going to look at the S&P, okay, US S&P, and I'm going to look at the daily option or auction. And what I want to see is I have a level here. I have a floor of 1800. I have a floor of 1780. And I have a floor of 1760. And I have a floor of 1760. But what I'm saying is by tomorrow's close, this is what I want to do. I want to, and remember, Nadex can be opened up with as low as $100. Let me go, I'm sorry. I didn't mean to close that all up. What I want to draw for you is the range. So I'm gonna be interested in this. And this ticket here is going to show me a range. It's 1800 is the floor. So right now, live, we're at 1803 3/4. Okay? So what I want to do is I'm going to show you that 1800 is my floor. What that means is I cannot, if I'm wrong, if I am wrong, remember institutional bias, probabilities first, risk is more important than profits, but I can only lose the difference between here and here at 1800. If the market falls out of bed tomorrow for whatever reason, it goes, cross your fingers, the thing crashes back down to 1550 or something, 1750, anything below where we're at. Obviously, you see my bias, but this is also going to give me the opportunity to participate anywhere all the way up to 1840. Okay? So again, current price of the S&P is 1804. I can identify a trade that will give me a floor at 1800. And I have upside of 1840. So, by the way, a quick little in is if you have a shortened week and it's a holiday week, just go long. Just buy long. We're in a bull market anyway. Buy long. So we're at least in the right direction. If I place this trade, let's say I look at one contract. Okay, for every contract, my maximum loss right now is $60. My maximum reward, it's already spelled out for me, is $340. Now, that maximum reward would only come true if by tomorrow at 4:15, the market is trading up here to 1840. Okay? But let's say that for whatever reason, and I always, for whatever reason, I don't think it's going to trade all the way up, but let's say it trades halfway up, 1819. I can at least look for a $60 risk per contract and take in probably about $180, $200 profits. So for every contract, $60 risk, $340 profit, and that's for tomorrow only. But let's say you have a full-time job. Trading is not what you do for a living, but you understand that we are at the lower end of a trading range, and you understand that it's all about risk and probabilities. So let's take a look at giving ourselves more time, and that is the beauty about options. Options are all about giving yourself or the trade more time to work out. So let's say, forget about tomorrow. I can put that on, but I can also put on something that's called a binary. And this binary is as such. It's going to give me a level, okay, on the S&P, and I now have the opportunity to do a weekly. Tomorrow, by the way, I'll have an opportunity to trade these every 2 hours. So I'll be able to initiate a new contract with somebody else on the exchange every 2 hours. But for now, right now I have the opportunity to do a daily or a weekly. So what I have an up bias. I'm interested in going long. We're in a bull market. We sold off towards the end, and the sellers couldn't take it down any further. They're going to be trapped. So I'm expecting the market to come up further, but I don't want to take a lot of risk doing it. Does everyone follow me so far? So what I want to look at is, let's take a look at 1819. I have 1817. So let's say, for instance, I believe that by Friday, given my entire bias, the market is going to trade above 1817, which is right here. Okay? We're going to trade above that. I can trade that for every contract a maximum risk of $16.50 to make $83.50. The reason is that these are derivatives. These are contracts that are traded on an exchange. They're each worth $100. So whatever you put up is your risk. And your max profit is your reward. Now the beautiful thing is I don't need the S&P to trade above. I don't need it to go to 1840. All I need it to do is trade up to 1817 exactly, or even one tick better. And I collect all 8350, and that is by Friday. Now the question that'll be coming through is, well, what if I don't want to hold till Friday? What if I get a nice pop and I want to take some off the table? What if I go $16, $16.50? I mean, anybody can do 10 contracts, right? So 10 contracts is you're risking $165 to make $835. Again, based on the fact that there's a high probability trade, low risk situation. The sellers couldn't take the market down. We have a shortened week. We have a holiday week. It's a long bias. We're in only if you're short, you're insane, that kind of market. So there's an opportunity here to risk $165 to make $835 by Friday. What will happen between now and Friday is if this trades to 1817.50, which is that right here, 1817.50, this option, this contract right here, will be worth 50. And then everything after that is going to be incrementally higher to 100. So the maximum you can make is 835. The maximum you can lose is 165. I'm sorry about that. I guess I was yelling. Yes, absolutely. But it's exciting, isn't it? I don't understand that question. Can you put a target on Nadex software so that one doesn't have to be near? Oh, a stop. Can you put a stop on? Yes, you can. If Nadex and binary options are so obviously simple, we are the losing end of these trades. You are the losing end of this trade. You are losing end of this trade if you lose $165. You're on the winning side of this trade if it trades above 1817 and greater by Friday. So again, just like anything else, there is, if you buy, someone has to sell to you. Same with a stock, same with a future. So the other side will be a loser. So that's why you have to have your probabilities. The probability. So the difference with options, and you can't apply the implied volatilities, but what you can do is you can place, let's say you go 10 at this level, but then you also go out and you say, okay, I don't think it's going to trade above a certain level. Let me see if I can open this up. Okay. This seems doable by Friday, 1817. But let's say 1840 is kind of, stretching it. What I could do is I can go out to 1840, and as it comes up through this 1850, but I see that there's some sellers coming in, this will be worth more than $2. I wouldn't want to sell it now. It's worth nothing. But at some point, I could sell that 1840. Conversely, you could also say, gosh, you know what? I'm convinced it's going to 1840. I'll risk $2. I'll risk $2 to make 98. and so on and so forth. So these are levels that you can trade based upon, again, this is just an instrument to trade, just like the options, just like stocks, just like futures. I don't want to get too much further into this. This is worthy of study, but the importance is to understand and to identify order flow and where the order flow trades. What is this telling me when sellers are really heavily selling and they can't take the price down? Well, this is telling me that this is going to be support. And so that's an opportunity to get long. And it looks like it's just been trading, currently, side by side, nothing much happening. So there's a wonderful opportunity here to take a mitigated risk. Remember, it's for tomorrow, you can have a floor of 1800, and for tomorrow only, you could have that target of 1840. I don't think it's going to get to 1840 by tomorrow, but I'm also willing to take, what was that risk? $60. But then I could also trade for the trapped sellers. And those are the most powerful trades that you can come across, is when a seller is trapped. I can go into multiple reasons why that's the case versus buyers being trapped. But let's just put it this way. The bias is to the long side, even at the Wall Street firms. Okay, let's open it up for questions. I'll show you what I use. I'll show you what I like. This is a new tool that I developed with Ninjacators called the Ninja Order Flow Trader. This will give me what I'm looking for, which is not only the data that I'm looking for, but I'm not interested in just the sellers. I'm not interested in just the histogram showing me there's sellers. Big whoop. Anything can tell me that. What I want to see is the block trades occurring. Okay? That's where I'm going to create my levels from. There's also some other information in here that I've developed into this. But then most importantly also is this pressure here, 1440, 440 on the buy side by 299. Big deal. Let's reset that. Let's say I want to get into a trade. And I go to myself, okay, if I want to get into this trade, no matter how you want to do it, options, futures, Nadex, I want the buyers to yell. I want them to yell at me. I want them to say, I'm buying here. I'm trapped. You can't do the binaries or the Nadex on stocks. What you have to assume is that sure. The gold trade was something we did in our morning room, and then in the this happened towards the 12:45 hour, and there was a long down here that was called in our room at the close of the room. And the reason, again, it's going to be based upon, if you take a longer term, let's do this with a regular chart. Forget about, learning all the bids and the asks, right? Let's take a look at a longer term chart. Let's go with 240 minutes, 4 hours. Let's see what it gives us. What can I say about this information here? There's a couple things. I can see that we were in balance here. Well, there was, a back and forth. I can see that there was a back and forth down here as well. And I can see that we're now trading towards the upper end. But more importantly, when we're trading down here, there was a low volume on the profile, and that's lack of volume, and that signifies rejection that came from some time in the past. I don't have enough data here to show you the actual volume profile, but trust me, there was low volume down here, and the higher volume is up here. Just imagine that over time, these 4-hour periods, there's going to be more buys and sells that occur at this level. So the market wants, remember, the market's job is to facilitate auction. It wants to trade back to the high volume areas. So it wants to trade back to 1280, the best that it can. And here, if it leaves 1245 and it's trading lower, again, it's called a low volume node. What you're interested in doing is you want to align yourselves with those low volume nodes where you're positioning yourself to where the market is looking for a buyer. It's become, the sellers are being exhausted, and the institutions will either be trapped and have to cover, or the buyers will come in. So there was an actual trade called live in the room on futures to go long in gold. By the time I looked at it in the afternoon session, there was not an opportunity for me to take it long in the Nadex. And that's an example that we went through live in the education session. Yes, there's lots of great information on the Nadex platform, lots of videos. Block trades will show in the volume by price. Yes, so Alan, again, importantly, let's go back to trade location. Big block trades happen all the time. Let me show you. Let's take a look here. Okay, same thing towards the end of the day. These were sellers hitting not only they were aggressive, big boy trades, right? Block trades. I have this set for blocks of 25. I want to see blocks of 25 or greater. In the S&P, I want to see blocks of 164 or greater. In the crude and gold, I want to see blocks of 15 or greater. Same with the Dow, the YM. On the ZB and the long bond, I want to see blocks of 89 or greater. Is there anything else? The 6E, I want to see blocks of 25 or greater. And in the most liquid days, I want to see blocks of 55 or greater. So again, these sellers, at the end of the day, yes, they were running out of time, but if they really wanted to, they did sell this off enough. But they pressed their luck and they got tired. And now this whole area here, 34.26 on the NASDAQ, is support. And actually, it looks like the NASDAQ came up off of those levels. Sorry if I'm going too fast on this. There we go. Came off of those levels. 25, yes. So blocks of 25. Dan, I can take indications of interest for, this is called the Ninja Order Flow Trader. Again, I'm not here to sell anything right now, you guys. There's tons of product out there for you to buy. Don't worry about that. My most important, I really want you guys to know that I've been there, I've done that, I've searched for the best indicators. It's not about the best indicators. It's about the understanding of the market and how it operates. I can't impress upon that to specifically some of the new guys that are probably here. More importantly than anything, it's not important to go out and buy this or to go buy our education product or be a part of our global trading room. It's not important. Forget about that. Markets will always be there. There'll always be the next best mousetrap. Trust me. This is not the end all be all. But what I can tell you is that if you guys will take this information and start focusing your efforts on that and that alone, you will really radically change the way you think about the markets and trade about the markets, you will start looking at it that, okay, I'm a business. If I'm a business, I got to buy and sell my goods. If I buy and sell my goods, or whether they're options or stocks or NADEX or futures or anything else, what do I want to do if I want to sell them to somebody else at retail? I got to buy them at discount. If I can get them wholesale, or if I can get them from the manufacturer, God bless, that's even better, right? Because I know I can make my money at retail. And yes, I can maybe I can hold for premium. Let's say, for instance, we were looking at this here. We see that there's a lot of block trades. Okay? We see that they're going to get stuck. They can't take it down any further. So let's go ahead and identify this whole area as a level. Okay? And if you want to get involved, either you're going to get involved down in this area and you want to start to sell premiums. You don't want to get involved really up in this area, because at this point, at this level here, right here, that's retail that you're selling at, and this is premium. So you're going to be taking some of your, you're going to be ringing the daily register, and that's what's important. You can do this without charts. You can do this just with looking at the time and sales. You can do this with, the different programs that are out there. Again, I'm not here, guys, to pitch you anything, I promise you. All I'm trying to introduce you to is option market theory and looking at orders, the actual market raw, and understanding that from an institutional bias, where risk is paramount. Risk is what it's all about. All I can really tell you. Is that fair? Absolutely. There's opportunity. 10 handles, 20 handles. I don't care about that. I don't care about 10, 20 handles. Those are nice. Those are vacation money. What I care about is how much risk am I taking to get that? Can I get into a situation where I can take 4 ticks risk on the S&P? Can I get into a situation and identify beforehand a crude or gold trade where my risk is, 6 ticks, 4 ticks? Everything else, after I sell to retail, everything else after that is just vacation money. And that is the importance of trading from a bias, an institutional bias. Remember, those guys, you hear about them. You hear about them making money every single business day, right? See that 4 tick, 6 tick for gold now? No, absolutely. I'd be looking for the short side. I'd be looking for the short side at this point. So let me leave you with globaltraderoom.com. We're a trading community. We're traders. Our main guy is an actual mathematician, physics major. He's the one that studied the tape. He actually, I'll be honest with you guys, when I left the trading for the big firms, I had a horrible time trying to trade from the retail side. For whatever reason, I found a needle in the haystack, and his name was Simon Joseph. And I'm not here to talk about any course, you guys. I'm serious. I'm serious about that. I'm absolutely serious. You can go through the website, click on the education. There's plenty of, if you are willing to do the work that's necessary to become a professional trader or trade like a professional, there's plenty of free information out there. I promise you that. But if you want to have, take a look at us, globaltraderoom.com. We're there every single day. We're doing it live right in front of you. Licensed, CTA, serious education. For those that are students, so let me talk to you about 2 things to finish off. I offer privates. I do privates. Okay, trade with a mentor. Go through in the more look at trader development. It's a 5-day crash course. There's me. How you doing? There's examples of traders that I've actually gone through, and here's some screencasts of shots that they've gone through. We also are introducing. We've always done. Let me just say this last thing, you guys. We've always offered 2-for-1 membership for the families to try to get their family involved, their younger involved. We're going to open this up to students. You have to be a student. It's going to be a scholarship program, but it's based upon that the famous, turtle traders. And all you have to do is, if you're chosen, you're going to get a substantial discount to the lifetime membership. You must be a student or a recent grad. You've got to include your email, your age, everything else. Okay? So just go to globaltraderoom.com. You guys, I really appreciate. I hope that you at least come away with some questions. Absolutely, market delta is phenomenal. I use it. But again, we talk about using indicators based upon running a business. Will that make sense? Will that price make sense for your account size? If turning the lights on, is going to be difficult for you, you may not want to go a certain route. So again, my name is Kai Whitney, part of the Global Trade Room group. Morgan, this is an amazing opportunity that you give these guys, that you give us. There's nothing like, I never thought I would be in this position where I could actually share some of the knowledge, because in the depths and the dark of coming over from trading, with all the capital in the world and everything like that, and I really had a hard time. And so I have empathy. I've gone through everything that you guys are going through now. No matter what level that you're at, you can always better yourself. And I really appreciate your time. I have taken up enough of your time. I appreciate it. Thank you so much. Again, tomorrow, Tuesdays, and every Tuesday, by the way. Click on the link, 8 a.m. to 12:30 p.m. Live trading, limited questions, please. Very limited education. We're just trading. Look over the shoulders of professionals. And join us also in our Asian session. We'll do a little more, it's a little slower. We can answer a lot more questions. Thanks again, everybody. Thank you, Morgan. Are you coming on? Am I rounding them up? Did I close it out again?
Yeah, thanks a lot. This is for your helping out.
You bet, you guys.
Sound all right?
All I got to say is, you can do it. I promise you. Just study order flow, study the markets, forget about buying indicators and all that kind of stuff. Focus on the education. Morgan, still can't hear you if you're coming in.